with Dan Fuss, and this year will be moderated by Jim Sarni. I would like you to also know that this is our first of our Distinguished Speaker Series. Sometime mid this year, we'll have Dr. Jeremy Siegel from Wharton. And to start off, we're also live webcast right now, so and this live webcast will also be recorded and posted to our new YouTube channel, the CFA LA YouTube channel. It's an honor to introduce these two gentlemen here, both of whom are very dedicated to the CFA, not only by their involvement within their local societies. Jim Sarni is a past president of CFA Los Angeles. Dan Fuss is a two-time president of Boston Society as well. And also, I think if we were to guess here, I'd imagine both of your investment operations team or investment teams would probably be filled with a majority of CFA charter holders.
Yep.
So it's good to know that we have a lot of support out there. In terms of, I'll start off by introducing Jim. He will lead our moderator. Jim Sarni is a managing principal at Payden and Rygel, as well as one of the more seasoned investment professionals within the Los Angeles area. You'll often see Jim Sarni on CNBC. You'll see him quoted in the Financial Times and Wall Street Journal. I'm going to hand it over to you, Jim.
Thank you, Frank. We paid him well for that. So I'll start off by stating the obvious here. We actually are, the only thing that's missing is the fireplace. So hopefully the warmth of this conversation will exude that warmth that would normally be coming from the fireplace. I have the distinct honor, Dan, of leading you in a conversation, and it really is a pleasure to do that. And as we all know, this is a man that really needs no introduction. But since you came all this way, I thought I do have a few notes and a couple secrets about you that I'll mention before we get started. Secrets.
Secrets.
They're good secrets, though.
Okay.
So Dan is currently the vice chair of Loomis Sayles, as you know, in Boston. He over 55 years of experience, close to 40 of those being at one company at Loomis Sayles. And how often do we see that anymore and hear that anymore? He earned his Bachelor of Science and his MBA from that wonderful Midwestern institution, Marquette University in Milwaukee. And he also served in the Navy and held the title lieutenant at the time that he retired from there. You know, as I was looking over his list of recognitions and accomplishments, if I went over them all, we would spend our entire time going over all of your accomplishments. So I'm going to highlight a few, and I'm just going to go back to 2009, but I know they go back further than that. In 2009, Dan won the Morningstar Fund Manager of the Year award in the fixed income category. Then in 2012, received both the Institutional Investor Money Management Lifetime Achievement Award and the Lipper Excellence in Investing Award. And then more recently in 2013, received the CFA Society of Milwaukee Lifetime Achievement Award. And as Frank mentioned earlier, he has been not once but twice the president of the Boston Security Analysts Society. I can tell you from my standpoint of being the president of a society, it's difficult enough to do it once, much less twice. And you were brave enough to do it twice.
Brave enough or foolish?
But you know, I will tell you that among your most good characteristics and qualifications, Dan, the one thing that I know I have personally been the most impressed in just watching you around, speaking around, and watching you where you go and what you do is that you always give back. And giving back to the industry and to the community where you came from is yep. You really have a focus on that, and it really is an honor to see people like you do that, and we really appreciate that. I'm kind of reluctant to say, because you might cringe when I say this, but you're often referred to in some of the things that I read as the Warren Buffett of bonds. So that's probably overused. But much, much more, I think, important and endearing than that is something that I came across when I was reading about a little bit about how incredibly clockwork-like that your life is. And you are very, as I understand, very consistent and very regimented in what you do and when you do it. But I think that really the most memorable thing that stuck with me when I read that was in a piece that I read recently, and an author said that Dan is a creature of habit, the best of which is regular success. And clearly he has proven to have regular success.
Well, please share that with Rosemary, because she says I'm a creature of habit too, but she doesn't add anything.
Finally, I will say, before we get into our conversation, found out that Dan and I share something in common. There's a few years in between, but we both were a member of the same professional business fraternity at our respective colleges.
That's right.
So he is a Delta Sig. He's number 703, if I'm not mistaken.
Yeah.
And even more interesting is your father was a member of Delta Sig, and it was number 33, I understand.
Yes.
So anyway, Dan, we're happy to have you here, and really looking forward to speaking.
Thank you.
One housekeeping item. Our meeting will go until 1:30. We will wrap this up by 1:30. I'm going to lead off in our conversation, as I said, and then most of you saw some postcards or cards out there for you to write your questions down. I'd ask if you would write your questions down, and there'll be people circulating the room throughout, and they'll pick them up and bring them to me, and then at some point during our conversation, I'll ask Dan the questions of the room. So,
all right.
So why don't we get started, and we'll give you the easy stuff first. Dan, you know, we all read a lot, and it obviously this depends upon what perspective that one has, whether one is an institutional investor or an individual investor. But the thing that I know I'm increasingly seeing a lot is that this is a bad time for bonds, and or certainly not a good time to be invested in bonds. And you know, as a bond guy, I kind of take that personally, and I'm sure perhaps you do too. But I'm just curious, Dan, if you could maybe start off by just telling us what your thoughts are about that.
Well, I understand why people feel that way, because I feel the same way myself. Net interest rates in the U.S. in dollars right now are scraping what appears to be about. How much lower do you go? You can go negative. But you have a rather consistent at the short end. The T-bill, the 90-day, last week, went at 2 basis points. 2 basis points. So in a separate account, you're going to put $1 million into T-bills, 90 days. It's going to cost you after expenses. So don't do it. Is this a record low? Well, yeah. I've been doing this since one of the Roosevelts came into office. I forget which one, but it was one of them. I didn't pay attention to the markets the first few months, but since then, and I don't recall rates like this. I heard the stories years ago of negative rates in the mid-30s, where some of the banks had to buy bills and it cost them. But since then, now, net, how you answer that question depends on who the person or the institution is, what their need is, what the benefit would be of going long right now, going in the market now, and then having interest rates go on up on you. And most people don't like that because the bonds go down in price. If you happen to be a longer-oriented investor, structurally, a life insurance company, a liability matcher, something like that, the best thing that can happen to you is to have the bond market collapse. You'd just rather wait till the day after than invest the day before, and you don't know when that's going to be. So it really is a trade-off between market sensitivity and reinvestment risk. And what are your needs? You've noticed I haven't answered the question here, John.
I'm sure you're going to get there.
Because there is no right answer to it. When I'm questioned by individuals these days who are taxpayers and have a reasonably high incremental rate and live in the state of Massachusetts, my answer tends to be, well, if I were you, I'd find yourself a good muni manager if you are not one. and I'd be in the muni market today, but I wouldn't go beyond 5 years. That's, for individuals, a much better market to deal with if, as I think, interest rates will eventually start up here. And I think they will. I said the same thing a year ago, and they've gone down. Well, actually, with the last few days, they're coming back towards where they were then. So there is no real answer. Aren't you glad I'm so precise here? You know, it depends who you are, what you're doing, what your needs are, and what your personal tolerances are.
Let's talk a little bit about the risks, Dan. It just seems as though the risks seem to keep mounting, whether it's political or geopolitical or economic risks. There are a lot of opportunities to go along with it, but certainly we don't have to think too long when we think about what the risks are that are out there. You know, as I like to say to people, I find myself saying it more often, is that the unexpected seems to be happening more frequently. And that certainly has been true in the last couple of years. So given that, I'm just curious, you've been investing for so many years, pre-crisis, taking the more recent period, with all the risks that are out there, what are you doing differently in the portfolios today than, say, pre-crisis?
In the portfolios?
In the portfolios.
Not in my personal diet.
In the portfolio.
Shorter. The best description would be the largest fund, Loomis Sayles Bond Fund, the best known. A couple of years ago, and for quite a long time, with very few exceptions, the average maturity. Now, I'm using average maturity rather than duration because duration is calculated with the level of rates in mind at that point. So if you're trying to look at how much you're going to bounce around, unless you've got a duration match going or running a life company portfolio, I prefer to look at average maturity. The average maturity 2 years ago in the Loomis Sayles Bond Fund was approximately 12 to 13 years. It's been around there. It was just sort of a byproduct of what we did. Much earlier, there was a period of time where the average maturity was as far out as 19 years. And we stayed put there for a while. In the last 2 years, the average maturities come into 6.5 years. Not a profitable decision if your alternative was to buy long treasuries. But it has come in. And some of the currency positions are much smaller now. The big one being Canada was cut about 60%. Too bad we didn't cut it 100%. But now I'm really happy we're there. And part and parcel of this, and part of the reason the average is in the bond fund, we built up a buying reserve of about 26%. And that is not easy to do when you have a monthly dividend. That reserve is now down to just roughly 20%. So what we're doing net is cutting the market sensitivity, which really hasn't been a good decision until now, really, until recently, and increasing the focus on specific risk, but building the large buying reserve. And I can get off into reasons. Net, most areas of the bond market are between fully and overpriced, and there aren't a ton of exceptions. And the exceptions tend to be small, and they tend to be scattered throughout the quality spectrum of essentially corporates, and have a real aversion to a lot of the structured products right now, the structured products that have the uncertain payback, because my guess is that the convexity in most situations is about the worst I've ever seen. So I want to get away from that stuff. We want to get away from that stuff. And just slowly, bits and pieces, odd lots mostly, or odd lots in our terminology. You buy them when they're cheap and you wait. Now, if you want to frustrate a group of traders, this is a real good way to do it. You know, you better have extra ice cream parties. So that expresses where we're at. I don't know when, as and if, rates are starting up in the dollar. The dollar itself, the technicians will call a spike, but it's a spike for obvious reasons because the geopolitical scene is tough. It's bad. So no wonder there's an inflow from around the world into the dollar. Hopefully it'll get better. Practically it doesn't look like it. Except Southeast Asia seems to have quieted down, at least for now, and that's the biggie, and that's good. But Eastern Europe, the Middle East, the budget that'll be rejected immediately by the Congress, one part they're going to approve, and that's for the first time in a long time. The defense budget, the revision from the early forecast by the administration is up. And I think the Congress is going to take that and add to it. And that, when you say, well, what does that mean? That means more borrowing by the U.S. Treasury.
Right.
So I've said enough on one.
So Dan, I just wanted to go back. You've mentioned in that response, you've mentioned the structured bond market, you've mentioned corporate bonds, you've mentioned government bonds, and I think back to my 30-plus year career, which isn't quite as long as yours, and I think about, while there might have been some breadth in terms of the types of bonds that were out there and the sectors that were out there, it certainly didn't have the depth that it has today. And so there was in one sense, I guess I would say it was a bit easier to stay on top of all these markets years ago because there just weren't that many things to follow, it seemed like, and most of it was the U.S.
That's true. That's right.
But we fast forward to today, and not only is there even greater breadth of securities and sectors, but it's within each sleeve. Structured bond sleeve alone, you've got asset backs of all different colors, shapes, and sizes. You've got all sorts of mortgage securities, and I know you said that you really limit more to the corporate
at this time.
But I'm curious, how do you, with the 25+ billion in just the Loomis Sayles Bond Fund, how do you do that? How do you organize the team, and how do you stay on top of all this to make the right decisions, or to make decisions? Let's put it that way.
It's really. Now, this is going to sound a little weird, but the way I think about it, because I don't know how many, if any of you, have you noticed, Jim? During our conversation, I've done 6 trades.
No, I hadn't noticed.
My cell phone's in the bag and it's shut off. No, I'm sorry, 7. 8. It's picking up now. 9. Okay, something's happening in the markets.
That's right, the market's not closed yet.
I know, 10, 11. Okay, it's going to be a busy end. We're organized, and this is sort of my doing way back, very much like an industrial psychologist would organize the company if he or she had their way about it. Now, I don't want to get off into a lecture or a seminar on temperament. However, when you look at the functions that are involved in our operation, just part of the functions, the part I deal with, research, a very perceptive, hopefully, function, trading, a very judgmental, short attention span function, and portfolio manager, the one that has to deal with the structure of the portfolios as a whole. And then you have the people that deal with the clients, and you have operations, which is a huge chunk of the people. Well, research to trading to portfolio is, in my mind, that's the key one. You need to have overlaps, and you need to have that go smoothly. Well, that's a wonderful thing to say. Just try to do it. That is really, now I don't feel bad about being out of Boston this week because I feel sort of guilty when I talk with the family. But that's my main concern, because we've got a ton of very bright, hardworking, highly motivated analysts. The key people in the process, I hate to say, are not the portfolio managers. The key people are your very, very senior, experienced, hard-working industry analysts. Yep. In both equity and fixed. In our case, most are in fixed. They're your key people. And a number of those people couldn't make a judgment decision no matter what it makes. Never go to lunch with them. It'll take a half hour for them to order it. But they have a wonderful perception of what the devil's going on in telecom. You know, 4 of them over in technology, so forth. They see the picture. And the fixed side is easier to deal with than the price of the securities, because you have numerical metrics to deal with. You have limits. The equity side gets tougher on that, and that cooperation, which means you're going to have a number of people from the portfolio side. They're not portfolio managers. Other firms would call them portfolio manager, sitting in trading. Mm-hmm. And then you've got the old guy. They come and pat on the head and say, what should we do? That sort of thing. And that's part of it, that coordination. The other part is that the west side of the room know what the dickens is happening on the right, on the north side of the room, because the north side is the basic markets. That's treasuries, and next to them you've got the international side, which has its own divisions, and then you work through the quality spectrum of corporates, and you wind up finally with the bank loans. So by the time you go through that whole thing, you have people with their own interests that if you're not careful are going to have their own volleyball teams, go to lunch together and never meet the other people. And markets overlap. Yep. Markets react to each other. So that every single morning for us at 9:15 we have what's known as the morning meeting. When in Boston, I lead it. When I'm out of Boston, it's a happier meeting. And each one of those desks, either the desk head or somebody designated by the desk head, tells you what's happening in their markets and the implications of that. And that better be rather rapid fire, because you've got a lot of markets to go through. And at 9:45, that thing's got in. It doesn't always. Some of the markets, particularly global lately, has been, you know, bouncy. So that everyone knows what the other one is doing or what pressures they've seen, because the markets do interrelate. The portfolio managers, other than me, keep their mouths zipped unless they have something to add to it. The analysts, you get pulled in. So what I do is really, I think, grand thoughts and all the rest of that. But I really watch how these people interact together. By the way, I'm up to 15 trades now. And that's not a joke. I'm relying on averages. I'm relying on the fact that we're in a situation where it looks like the dollar is not forecast. The dollar has cracked. And that is now starting to play out in the markets. So, back to you, Jim.
You know, Dan, there is there's that saying, and I may get it wrong, but it goes something like, you know, the more things change, the more they stay the same. And I believe that really is true in many cases, but there's one area in the bond market that it certainly is not, and there really has been a game changer really pre-crisis, and that has been the tremendous amount of central bank intervention in the markets.
Yeah.
Now, obviously, we're on the tail end of our intervention with the Fed, but ECB is ramping up, and Bank of Japan is trying to do what it can. That really is a game changer, as I see it, for what we are trying to do as bond managers. And I'm just wondering if you could maybe comment on how does that fit into the mosaic of this decision making that you were talking about?
Thank you. I think if I can add anything of value here, beside the what will be accurate forecast that the Red Sox will win the pennant this year. The one thing I would add is for those of you who pray at night, like I do, toss in the Fed, because they need it. Because what's happened is for the 5 major central banks, the world it's always changing, but this time it was sort of a ramp up. It started about 1.5 years ago, and it's not over. And our own central bank is really caught between a rock and a couple of hard places, because they're having to operate outside of their mandate. And that is, by the way, an inference from me. They'll never say that. But there they are. What's happened is that after years or decades of a gradual improvement in the environment of peace or lack thereof, about 1.5 years ago, or a little more, actually, 1 year and 8 months ago, things started to sort of go the other way, and the stress points started to build. Now, this is not a political science lecture, but they started to build, and it was primarily in what I euphemistically called the South China Sea area, Southeast Asia, and all with the emergence of China, etc. And this started to make those markets more sensitive. And these markets, those markets, had already had a pretty good inflow of US dollar-based investment, some other currencies, and euro-based investments. And part of that inflow was coming through vehicles that could come in and, in effect, sell the securities, take the money out. Open in mutual funds, and then the ETFs. And it was building and building and building and having an effect on valuations. Then you started to see signs of stress over there. People might worry if they pick up the paper and see riots in Bangkok. That was the one. In the first week of December of 2013, during the first 2 days of an ASEAN meeting held in Tokyo, interesting, Japan's not a member, China's not a member, Taiwan's not a member, South Korea's not a member. The Bank of Japan, and this was the tip-off, it took a while for it to sink in with me. The Bank of Japan announced with a lot of fanfare the establishment of 10 bilateral currency swap lines, one with each member of ASEAN. In the explanation for this, in the newspapers, luckily English language version for me, it was very, very clear. It said, hypothetically, if any member of ASEAN should need US dollars or euros to meet a sudden outflow of money, that country does not need to run down its own reserves in those currencies or sell their own currency. And I thought, well, that's interesting. What are they going to do? They say, all you do is call the Bank of Japan. You need dollars? We will send all the dollars you need. Pretty interesting. Last I looked, the currency was yen. And the reason for that is the Bank of Japan has an open line, currency swap line. Now, there must be a limit in there somewhere, but they didn't mention it, with the U.S. Central Bank. As a matter of fact, the top 5, U.S., Euro, Japan, Swiss, UK, they all have this swap line arrangement with each other. So the point of this, they described, and it was very accurate, they referred back to 1998, 15 years prior to that, where you had the troubles in and the money flowed out and the currencies went in the tank. Should that happen, this will help prevent that. It happened at that time is when Bangkok was having their serious riots, when somebody was shot dead in front of the central bank. That unnerves the central banker. And the Thai baht had already started over like that. It looked like the beginning of Niagara Falls. That day till now, the most stable currency around in that area, other than the Hong Kong dollar, which is fixed to the U.S., has been the Thai baht. Next, the other one that had some real trouble was the Philippines. Same thing, not quite as tight. That was within the Bank of Japan's mandate. That was, you know, supported by the government, saying this is a really good thing. It was perceived at the time that it was a reaction to the East China Air Defense Zone by China, and it was a political move, and that was probably part of it. But it was a very, very good thing for stabilizing money flows and markets and economies over a broad area. Okay, let's go right to our own central bank. Our central bank is a creature of Congress. It came together, as Bill Martin used to drill into me. He said, Dan, for heaven's sakes, this was a political compromise. You had to get all the, I guess his dad was involved, and you get all these things in there together and move the money back and forth. Now, beyond that, you're supposed to fight inflation. And I would add, nowadays, you have a mandate to help employment. Now, look at our own central bank. We've flooded the market with money, trying to come back. The small bankers are crawling for higher short-term rates. And the measuring points for the mandate are employment and inflation. Okay. Employment, we've punched through the unemployment goal a couple different times. But our central bank can continue to sit there and look at that and say, oh yes, but let's examine the labor market and so forth. That's not going to cause them grief. In my mind, my guess is you could probably take the unemployment rate below 4 and still claim you know, they could handle that one. At least the people at Bank of Boston certainly can. And the other ones, this is a hard place. The other ones, the inflation rate's very low now. It's not a problem, right? Okay, that's wonderful. Look at the things that run before a move up in the inflation rate. They're a problem. I won't get into all of it now, but it's coming. We'll get a respite from the layoffs in the oil patch, but that's coming. Now, what's the central bank going to do? They say, well, it's pretty easy. As soon as you get a little more evidence, you're going to start to let short end of the rate go, the curve go up, and then rates will go up a bit more. No. What happens is the money flows that are already, they've trickled down a bit, but they're still there from parts of the world you wouldn't anticipate. They're coming. And we take rates up, they jump. The Fed knows that. Is that good geopolitical management? Are the people at the State Department going to be happy about that? Absolutely not. We're trying to build better relationships there. We're trying to help in those areas.
Right.
So what are they going to do? You say, well, okay, they'll just continue to sit on interest rates, keep them down. How are they going to justify that? Where in their mandate does it say that? It doesn't. Oh, well, they'll just explain to Congress. Fat chance. They report to Congress. So what are they going to do? I really don't know. Well, why don't they do an expanded write-up? They've got a paragraph in the minutes now, but it doesn't really cover this part of it. They're just starting in speeches once in a while. Somebody, not a board member, will say, well, you know, we have to be careful because money flows into the U.S. dollar. Now, lucky for them, I think, think, maybe, I think the spike in the US dollar is over. The money flows aren't. So what is Fed policy going to do? God help them. And I'm not joking. What are they going to do? Well, I don't know. They'll probably try again. They tried briefly in December to let the short rate come up a bit. Boy, that didn't work. Although you've been able to leave Fed funds up a little higher, you got to get the T-bill right back to 1 or 2 basis points. So they'll have to try again. And again. Maybe right now, if I were them, I think I would try it right now because the dollar's getting creamed. So that's a good time to do it. It's a psychological thing. Our central bank has an international role. It has the most important international role. And it has constraints in its guidance, its act, that constrain it to a domestic constraint. So, how can they deal with that? I don't know. I don't know what they're going to do or not do. But I think that is a crucial part of the market, and I think the geopolitical side is the dominant part of the market. The strains in Eastern Europe, where people do have a button that says launch, Middle East, and the one area that, at least for the moment, looks to be getting better, Southeast Asia, where all of a sudden the tension's gone down and there's more cooperation. Those are the big market things. The rest of it is you deal with specific risk. You got a speech instead of a visit.
It's okay. You're answering a lot of other questions in the process, so I'm able to check some things off my brain as you're talking, so this is wonderful.
Okay.
Dan, there are a number of questions here, and I'm gonna switch to some of these because the good news is you're answering some of them. There were a number of them on the Fed policy and things, and you've spoken about that. But one area that I think I would be remiss if I didn't bring up is oil and oil prices.
Yeah.
And you've mentioned inflation, and you've alluded to it a couple times. There are various questions on that. What are your thoughts on what we're seeing today, and is this likely to continue? Is it going lower, going higher?
Well, the one thing about oil I'm very aware of is, thank goodness we switched to natural gas a long time ago, because the oil trucks can't get through to deliver oil in Boston. So people's oil tanks are going. Whoever thought of putting an oil tank 10 feet from the nearest driveway is, I don't know. Yeah, I don't know how it's going to play out. Boy, you talk about geopolitical.
Yeah.
I don't know how that's going to play out. It definitely has an impact on markets psychologically, but also fundamentally. And so I just don't know. Our technicians tell me that oil is bottomed. I look at what they write. Sounds reasonable to me. It sounds like what they wrote 2 months ago.
So are there opportunities in the?
Oh yeah.
In the.
Yeah. But you really need to know your companies here. And even then, you can have four, as we do, analysts trudging around in that area, and they can really know their companies. But what you have to look out for is they say, well, this is a perfectly fine credit with oil above, and they write in the number. So then you have to find out what the lever is if you go below. If 60 is a wonderful number, 50 is passable, what happens at 45? Oh, they're broke. Oh, well, that's not a good outcome. And you don't buy this type of credit or stock when on the bounces. You wait till there's a desperate need for a bid. So you have to be very tolerant of very high specific risk, item by item. and better put that in situations that they can handle that. Don't have any approach in there that's relying on any kind of explicit or implicit leverage. Because you, at the end of the day, you'll wind up with zero. But that's where your opportunities will come from. But you better be on a cash-only basis. So what you do in these cases, you bring a bid to an illiquid market, and you know you own it. And you're going to be looking at that for a long, long time until it hopefully matures. Or, the rest of the world agrees it's good credit. So that type of approach is what you do in energy-related names right now. Stock side's a little different.
Yeah.
But it's still the approach. It's just you have a little more liquidity in the market.
Dan, you talked about, and I think I know how you would probably answer this, but there are a number of questions on asset allocation. And if we focus on really the corporate market, there's the whole credit stack from investment grade to below investment grade. And questions on how you make that decision. I know that you talk about you really are a bond picker or a stock picker. You're really more bottom up. But is there to what extent does investment grade versus high yield enter into the picture, or is it truly just all about the companies that you own, regardless of their rating?
It's more the latter, but on the investment grade side, long. And by investment grade, I mean really more triple B plus, maybe some triple B, long call protected. You have an unusual demand. Right now, most of it's sitting in the wings. This is a liability match. That has been a factor actually in the long treasury market, because some of the, I'm sure people here in this room have encountered this, some of your current clients have added another tranche even at these levels, because they managed to sell their stocks synthetically at the end of the year. So the sell in the stock market, they had already captured, and they didn't want to chance it, even though the level of interest rates on long investment grade corporates wasn't there. Well, they put the money in anyways. This quite frankly has surprised me. Number one, it proves that they don't listen to what I say, so maybe that's all right. And you have to, in a few cases, immediately cash only. Most cases, you can cover it synthetically for a few months, but then it's got to be cash, this stuff. So you've got to get it in there. And you just can't find the long corporates. So what do? You buy more long treasuries. And that has really driven the long treasury market. Now, that is starting to come apart. I wouldn't count on it staying apart, but that is starting to come apart, not because you're finding long corporates. So that market is thinner than it used to be, quite a bit thinner. And that has really surprised me. It was never before have I had on my radar screen that we would worry about any segment of the treasury market. Now, this is all relative. It's still a fairly liquid market. But for several of the people in the room, and certainly for us, how much does it take to move, say, 3 basis points? How much can you do? I don't want to get into too many numbers, but it is now a small fraction of what it used to be. About a tenth what it used to be. And that's a little disturbing in view of how much treasury debt's out there, but once you get into who's actually holding it, then you start to understand. So
we're going to switch the focus back to you a little bit. There are some questions about your favorite books, people that you admire, and out there today. What are you reading? Who do you look to for your guidance and more wisdom than you already have?
Well, there are a lot of people in the world that have more wisdom than I do. All the ones that I really followed and admired have died. I'm old. Plan on being a whole lot older, by the way. I'm going to rephrase your question. I've been doing that anyways. You learn from people you work with. You learn good things. I've learned some really, really good things in years past from somebody that Jenny and I worked with, Wally, an assistant controller who had within his power and his magic to keep a public pension fund overfunded. And that is about the most incredible thing I've ever seen in my life. I learned enough to keep my mouth shut the whole time he was there. But now.
Well, what he and his predecessor did by contributing to the pension fund in the 80s and the late 70s, they just kept contributing.
Yep.
You know, they didn't just contribute the minimum. And
right.
Milwaukee, the city of Milwaukee, which stands for the #1 funded pension fund public plan in the country.
Well, that's because Wally was a good politician. So I learned a lot from him. I learned a lot about dealing with our parent company. I learned a lot about dealing with other sectors. So Wally was a good teacher. He also found the cure for the persistent cough I had from a medication. He surveyed the office. That was very good. Obviously learned a ton from my dad. I really did. I learned a ton from fourth one, David, of my children, about how to deal with people. I learn a lot regularly from Rosemary. And I learned a lot in the business in many respects from Bill Martin. That was a brief, it was one, well, we kept in touch for many years. I would have breakfast with him about twice a year. And a lot of other people. So I guess really by osmosis, you learn these things. And the key thing I think I've learned business-wise is actually, I learned it in the Navy, and that is to walk the decks. I still walk around and hand out my own stuff. I don't do it in the second elevator bank now. I restrict to one, just to get a sense of what's going on.
Yeah.
Just to get a sense. How, to come back to the temperament of the operations, you'll have people who are not of that temperament working in that area. But you have an organizational, sub-organizational temperament. And those transition points of moving perceptions to action are tricky. And I've become a Myers-Briggs aficionado. I've become all these different things. Nowadays, it's neurology.
Right. What about the other thing that is big in our world is we all know with the dealers, with the regulatory environment being what it is, and Dodd-Frank and all these things, that the liquidity certainly is a big, big factor in what we do or don't do. And with more trading migrating to some sort of an electronic platform, it's a much different world now.
Yeah. It is. Well, the sort of the pop discussion or description of it, I think, is actually the best one. The buy side has gotten bigger, and the sell side, in terms of its liquidity function, has gotten smaller. So you would anticipate more volatility, and I agree with that. I think you have to limit to what's going to cause it. But I'd say the potential for volatility is higher than it was. You can, just look at the math. The smaller present cash distributions means more in the future. You're going to have more volatility. Okay. And that's not changing. So that's just a fact of the matter. The side benefit is when you look at any array of whether they be fixed income or equity accounts, as long as you have a long enough time period, I'd say at least 10 years, you just use your own accounts. Look at your own accounts so you're sure of the data. You're going to find a darn good correlation between turnover and performance. Unfortunately, it's a negative correlation. And you sort of expect it in stocks, but it's surprising that you find it in bonds. Now you have to adjust again for the average maturity of the bond fund there. Short-based funds obviously having higher turnover, and the liability matchers will have a much lower turnover. But that lesson right there, that you look at that and you say, I wonder why that is. Because on the stock side, you'll have 3 or 4 year spurts where the higher turnover is doing wonderfully well, and all of a sudden crash and burn. There are a couple exceptions here and there, but boy, not many. I call it, well, I better not go any further that way. Just look at some of those correlations.
Well, I see we're getting, close to the witching hour is just about upon us, and I saved what is probably the most important question till last.
Okay.
And this is not my question. What is the likelihood that you will surprise us and leave Loomis Sayles?
0. Oh, wait a minute. Pardon me. There is a risk. It's diminished now. As the defense budget expands again, they are the Navy is quite likely to decide to refurbish a couple of the carriers. And there will not be a signal officer left in the U.S. Navy that will know what the devil to do with some of these things. And I can remember that clearer than what I'm supposed to bring home from the store for Rosemary at night. That part I can remember. So, so the risk, our parent company's chairman was pushing me on this point. And he phrased it, he knows I won't not leave Loomis. But he said, what about retiring? And I said, no, and I showed him the area in the office where they were going to bury me. And the French don't have a sense of humor. And he finally got frustrated. He just said, how much longer are you going to work, Dan? I said, well, unless the Navy recalls me. And he didn't understand that at all. I said, I'll agree to another 30 years from my next birthday. Now, you say, well, what a dumb thing to say. In view of I did careful work in picking my parents, so that's a big help. I don't know. The question is, how long will Loomis keep me? And the answer is probably as long as I can challenge anybody or be challenged by anybody in the morning meeting. Because when I'm not out here in the sunshine and back there in the snowdrifts, I lead that. And that's where the rigidity comes from, because I do get up at, about 4:20 now. Used to be 4, to prepare for that meeting. And when the day comes I can't do that, the whole world will know it. At least everybody in that room will. And that's a good lesson. Yeah. There are more sane people in the world than I am. In fact, most everybody here certainly. But that's what I like to do. And on a very serious note, because this will apply to more than several of you, one of the passions my wife and I have in the world is the area of neurology and research. fundamental research. And we're funding things over at Boston Children's. And I've discovered, quite by accident, that just because I'm a nice little old man, I get more stuff done that, you know, you talk about politics, dig into the medical situation, oh my God. You can get a lot of walls jumped or barriers with the door in them to fund stuff that has already been of quite some help at the very young ages. And so I've decided for no other reason, I'm just going to keep doing that. And Rosemary supports me. Matter of fact, I think she wants me on it. But home for dinner.
Well, I'll take the over on how long Loomis is going to want you around.
Okay.
So, well, Dan, I'm afraid that we've come to the end of our chat, and the fire's just about running out. So I guess it's time to wrap it up. But on behalf of all of us, I really want to extend a warm thanks to you for taking the time to come out here. And I know it was tough leaving that great weather back there. But we hope that we were kind enough that you'll come out and see us again.
Try February.
And there were a number of questions that we didn't get to that were wonderful questions. I don't know how tight your time schedule is. I know we do need to adjourn, but if I'm sure you'll probably have people coming up to you after, and
And I noticed the dessert was safe. So that's good.
But so Dan, thank you very much.
You're welcome.
Appreciate
Thank you.
Your time.